In this video, we're going to talk about how to trade boom and crash. So let's dive right into it. The first important thing that you need to know is do not trade ticks when you're trading boom and crash. The spikes, these are the spikes. The spikes for a crash are the black candlesticks, and the ticks, they represent the blue candlesticks. For a crash, when it comes to a boom market, the ticks are the black candlesticks and the spikes are the blue candlesticks. So you need to differentiate between the spikes and the ticks. Do not trade ticks. If you trade ticks, your stop loss is most likely going to be skipped and you will be taken out of the market, or your order is going to be executed at a later price, and we don't want that. And for those who don't know what boom and crash is, these are indices that are provided by the broker code Deriv, link in the pinned comment below. So now, first things first, when we are trading boom and crash, we want to look for a flag pattern. We always want to look for a flag pattern, and this is the flag pattern. Here's an example. For a crash market, we're going to be looking to sell. When we're in a crash market, we're looking to sell. When we're in a boom market, we're looking to buy. So in a crash market, we're looking to sell. So here's what we're supposed to do here. Use this tool, the equidistant channel. Draw your pattern. Draw your flag pattern right there. And as soon as you draw your flag pattern, then what do? You're going to look for price to break out of this channel. Now let me position this just the proper way. Okay, I'm looking for price to break out of this channel. As soon as price breaks out of this channel, I'm going to look to sell. And if we look at it, many people might not be able to enter here because they might enter late, because by the time most people enter when it breaks out of this channel, the price would have left them and would have crashed a long time back. So if that happens, well, my strategy works this way. There is what we call the Fibonacci retracement tool. You can use the Fibonacci and wait for price to come back to your 71% level or your 79% level. When price comes back to the 79% level or 71.5% level, look for a supply zone and then enter off that supply zone, and then put your stop loss just slightly above this high. Put your take profit. There is liquidity here. Put your take profit where? Right on this demand zone. And look at what price does. Comes and smashes your TP. Hold that for the whole day up until the next day, smashing your TP. Here's another example. Here's another good example of a crash market. Mark your equidistant channel. Mark your equidistant channel. This is your flag pattern, and you're waiting for price to break out of this structure. As soon as it breaks this support level, this flag pattern acts as a support and resistance. The top one is the resistance, the bottom one is the support. As soon as price breaks this trend line, this support trend line, you're going to be looking to enter on the filling in of this imbalance, and you wait for price to hit your TP right there on this demand zone. So now I'm going to show you how to enter using the imbalance, the filling in of imbalance. If you don't know what imbalance is, watch the following video that is going to show on screen. So let me illustrate now how candlesticks form. So usually when candlesticks form in the market, this is what happens. Price opens, goes up. This is for a crash market. Now this is for a crash market, guys. Usually when a candlestick forms, that was when price went up, it was forming the high. It was taking out orders. And then what happens when it crashes? It goes down like that. It's so sudden. It takes about 1 second for a crash to happen. Like boom, like crash, it goes down. So whenever you see a rejection, you're gonna wait for a rejection. And as soon as price, whenever you see a rejection like this, you see a rejection when price was going up, and then there was a rejection, most probably in the lower time frames. That was a crash, a small crash. What are you going to do? You're going to wait, and then you're going to enter here on the open of the candle. Place your stop loss. You're going to place your stop loss just above, slightly above this wick. And then what is price going to do? Most probably price is going to spike down. And then you hold until price reaches your entry, reaches your take profit. So another important thing to note whenever you're doing all of this is how candlesticks form. So when candlesticks form, they need to be balanced. Their shadows need to be balanced. So if there is ever an imbalance, this is where you're looking to enter. So let's say you were in your crash market, this was your support, and price is broken through. Let's say there was another candle here. There was another candle here. This is the shadow of the other previous candle on the H1 time frame. And now you're looking to enter here. You're looking to enter when price balances this wick. It might not balance it totally, but whenever price comes back, let's say this was the open, this was the open. Let's say price comes back and then shoots down as the crash. Maybe it didn't totally balance out this imbalance. As soon as this happens, you're looking to enter here. This is where you enter. And when you see a spike like that, you place your stop loss slightly above this wick and you hold your trade. So now let me illustrate this on the charts. This is how we entered here. Let me show this to you guys. This is how we entered here. As soon as price broke this trend line, this support, we waited for it to fill in this imbalance. And what happened when it filled in that imbalance? What happened when price filled in that imbalance? Price shot down, you entered here, placed your stop loss just slightly above this wick, targeted this demand zone, and then held your trade. This was your entry, this was your take profit right there. So look at what price does, smashing your take profit. This is the crash market. Now let me give you an example of a boom on a boom market. This also happens on a boom market. So when you're in a boom market, you're looking for the flag that forms downwards. You're looking for a downward flag. So this was a downward flag, and you were going to be looking to enter where when price broke out here. This was your entry. And if we zoom in, we find that price filled in a little bit of this imbalance and it shot up. You put your stop loss slightly below this. So here's another example here. Here's another textbook example. You're looking for a downward flag pattern. This was the downward flag pattern. This was the downward flag pattern, and we're looking for price to break out of this, essentially. This was the flag. We were looking for price to break out of this channel, and what does the price do? Breaks out of this channel. You were gonna enter right there. Price came back to fill in this imbalance and shot up. You would have targeted one of these highs right here. You would have targeted one of these highs as your take profit there. And if you had missed this trade, this is the beauty of this strategy. If you had missed this trade, you would have placed a Fibonacci retracement 2 right there for this impulse. And what does price do? This is your supply zone. This is your demand zone, sorry. This is your demand zone. Price reaches your 79% level and it forms an engulfing candlestick pattern, shoots up. And if you had missed this entry, you would have waited for price to fill in some of the imbalance and shoot up. Fills in the imbalance, shoots up. Fills in some imbalance, shoots up. Happens over and over and over and over again. Easy. So this is how you trade boom and crash. Before leaving my channel, please hit the subscribe button to get more and more tips on how to trade boom and crash. How to trade boom and crash, guys. This is it. Thank you.